You're listening to Simply Put, a podcast from FHN Financial. I'm your host, Will Compernell. The number of homes built since the global financial crisis has fallen well short of what's needed to keep up with demographics, pushing housing affordability near historic lows. Homebuilders will now have to contend with federal policies that could exacerbate existing obstacles like onerous building regulations and a chronic labor shortage. Meanwhile, elevated interest rates and economic uncertainty pose difficulties in forecasting future demand. On today's episode, we talk with Robert Dietz, chief economist with the National Association of Homebuilders, about what's driving the nationwide housing shortage, the impacts of new federal policies on home building, and his views on the longer-term housing market. Stay tuned. Coming up soon, our interview with Robert Dietz, but first, a quick market update. The U.S. and China agreed to a general framework for bilateral trade policy earlier this week in London. The details need to be finalized, and the handshake deal still needs to be approved by President Trump and President Xi. The U.S. market response was pretty muted, perhaps a reflection that investors are wary of celebrating improved trade relations until the negotiations are complete. Also this week, the May CPI came in much cooler than expected, with the headline and core indexes both rising only 0.1%. There was evidence of some tariff pass-through to categories like toys and appliances, but disinflation elsewhere kept the broader indexes in check. It's plausible that businesses in other tariff-sensitive sectors were able to draw down inventories rather than raise prices, creating the possibility that price increases will emerge gradually over the following months. Last week, payrolls grew slightly more than expected in May, though downward revisions to March and April meant that strength was overstated. There were certainly pockets of weakness in the report, but the steady 4.2% unemployment rate is likely enough for the Fed to continue exercising patience in telegraphing any future rate cuts. The Treasury curve bear flattened over the last 2 weeks, with the most significant selling pressure coming after the May employment report. Yields on two-year Treasuries are tethered to 4%, while yields on 10s are centered between 4.4% and 4.5%. Fed funds futures are now fully pricing in the next rate cut at the October meeting, with just under 50 basis points of easing expected by the end of this year. Mickey Bowman was confirmed as the Fed Vice Chair for Supervision last week. In her first public appearance since confirmation, she unsurprisingly expressed a desire for more bank-friendly regulations compared with her predecessor, Michael Barr. Among her many policy priorities, she hopes to reform the supplementary leverage ratio, which we talked about in the most recent episode of Simply Put, bank capital requirements, and stress testing. That's all for the market update this time. Now, our interview with Robert Dietz. Our guest today is Robert Dietz, chief economist with the National Association of Homebuilders. Robert, thanks for coming on the podcast.
Yeah, it's good to join you today.
Our topic today is home building in 2025, how new federal policies and the current economic landscape will shape residential construction this year and onward. Robert, whenever housing affordability is mentioned, I also hear this idea that we have a housing shortage. Is this true? Do we have a housing shortage, and what's the best way to measure how big this deficit or surplus is?
We do. The size of the housing deficit is a matter of debate, but I think it's important to kind of put it into perspective. When we talk about the housing deficit, we're really talking about a mismatch of the size of the housing stock, all in, single family, multifamily, rental, for sale, versus the size of the population and the number of households. And that mismatch is probably about 1 million or 1.5 million residences. And it's due to a certain amount of underbuilding that occurred coming out of the Great Recession up through the COVID era. Now, we have to make sure that we distinguish that housing deficit concept from the cyclical near-term issues of, where is existing home inventory, how much demand in the coming 6 months is there for new construction. But overall, due to a variety of structural factors in the home building industry, we have underbuilt housing for the last decade, and it has resulted in a more than a decade low in housing affordability. And of course, a lot of frustrations for younger buyers and first-time home buyers.
So 2 follow-up questions. First of all, how much of that shortage is not enough housing is where people want to live? So housing, unlike, something that I buy on the internet or a movie that I stream, it's really difficult to transport it. So how much of the shortage is not necessarily a shortage of national homes being built, and it's more that we don't have enough in, the high productive metropolitan areas where there are a lot of jobs?
Some of it, not all of it. So, that is absolutely a factor. I know one of my favorite economists, Ed Glazer at Harvard, has talked about the fact that we don't have enough housing and dense housing in these agglomeration areas of high productivity, job growth. And when you think about the areas of the country that have seen productivity growth, the benefits that come from larger metropolitan areas, they often tend to be the areas where it is the most difficult for builders of single-family homes, of apartment builders, to build in those markets. So, you think about the coastal markets. And so some of the housing shortage is a fact that those areas have seen population growth, and they just have not seen a response given the job growth and population growth in terms of their size of their housing stock. However, when we've done our estimates of how large the housing deficit is, it is kind of remarkable the degree to which you see pretty much every market in the country having lower vacancy rates right now compared to their historic norms. So I think some of it is due to the supply side of the industry, that factors like the skilled labor shortage, that there's not enough capital available to smaller builders, supply chain issues, all these different factors have led to a certain amount of underbuilding just about everywhere in the country. And then where it's most acute and where it's most severe is in combination to cities, whether due to geography or by design, inefficient policies in terms of zoning to bring land in that can be built, that have made the housing deficit even more severe in these high growth areas. San Francisco is a great example, right? The tech centers, really hard to build, and the result is a housing affordability crisis that's acknowledged by California policymakers.
So I understand that regulation aspect of it. That has always seemed the most intuitive to me. But you talked about how there's been a shortage in the wake of the Great Recession, the financial crisis, which was about 16, 17 years ago. So how did we go that long with not building enough housing? What happened over that time where we never got back to building enough?
Well, I think to start with, you cannot understate the degree to which the Great Recession and the housing crisis really wounded the residential construction industry. At peak employment, there were about 3.5 million workers in the sector, and by the time it was all over, there were less than 2 million. So there was just a large amount of talent that left the industry. Something like half the home building companies in the country went out of business. So you have that entrepreneurial loss. We had a series of regulatory policy changes, and then it's harder for economists to measure, but it really does matter. There was a certain amount of risk-taking that was lost by the industry as well. Once the inventory glut that was pretty much worked off after the homebuyer tax credits and some of those issues in 2012, the industry just didn't come back as fast. And as you noted, it's been more than a decade. This is an issue where a series of supply-side constraints act in tandem with each other, making a set of small problems a really big problem. So the industry has made progress on some of these issues, things like getting better zoning into play, getting capital into the sector, recruiting workers. But without solving all of these issues, the industry has continuously underproduced. So it's a game of yards rather than kind of a deep pass into the end zone. The industry continues to make progress in terms of building up its supply chain, but the end result is that the actual housing stock for the country is too small, given the number of households and given the size of the population. And we can see the impacts of that clearly in the number of young adults who live with their parents. 20 years ago, roughly 1 out of 10 25 to 34-year-olds lived with their parents at home. Today, the number is greater than 1 out of 5. So it's resulted in households that have not formed. And then there's a whole set of demographic and economic consequences that come from that, including declining marriage rates and something that's increasingly being talked about, declining fertility rates, which then has impacts on labor supply and other kind of long-term growth issues.
I can understand the scarring impacts on the industry from the bust in 2008, 2009 onward. But what about the boom? So some people will look at the financial crisis and think about the housing market aspect of it. Was there, a so-called bubble where there was too much supply, or was it just that, I don't know, bad credit was overinflating it? It wasn't necessarily too much housing supply. It was just that the kind of households that were engaging in this borrowing were on the best terms.
Yeah. So, again, we're going back to 2006, 2007. The industry was building to a certain amount of phantom demand that simply didn't exist. It was demand that was being confused for organic household formation growth that was really being driven on the demand side of the market by poor mortgage underwriting. And of course, going into that, there were a fair number of people within the industry. There were certainly analysts outside the industry that said this will end badly, that there was overbuilding, the price growth was not sustainable. And again, it was really kind of rooted on this demand side of the market. The shame of it is that, this happens in markets sometimes. Markets do what they're going to do, which is punish the people making poor decisions. The scarring occurred, but then the impacts from what was a demand side issue then materialized on the supply side of the industry. And so the issue for the last decade or so, and I've sort of called these supply side constraints the 5 L's of the home building industry, which is a lack of labor and lots and lumber and building materials, lending, particularly to private builders that build about 60 to 70% of the housing, and then issues around legal and regulatory burdens. All those factors combined into a set of constraints that resulted in us having this housing deficit. We're making progress. People often point to me and say, we saw a demand side shock that came about from COVID when we had historically low mortgage rates and demand increased. And I would argue that example was proof that our thesis is correct, because you saw the industry really try to step up and meet that demand, but there were limits to it. And the one area where there was an obvious impact came about in the lumber market. In early 2020, the average price of softwood lumber was around $350 per thousand board feet. And by 2021, it was up to $1,500 per thousand board feet, up by a factor 4 to 5. So it was almost like the industry was operating on afterburner, or above 100% throttle. And they did so for about a little bit more than a year, and then it kind of had to slow down. So there are limits to how much housing we can build given the industry's pipeline right now. The issues I think we're facing going forward now really are more about policy uncertainty, and I think increasingly in a lot of local markets, rising existing home inventory, which really hasn't been a big issue for the industry since before COVID.
I think the pandemic did show us just how complex supply chains are under the radar, and a supply chain is only as efficient as its weakest link. And I remember that lumber shortage. People would post a picture of a pile of lumber and say, "This is my new retirement account." When we're thinking about those shortages, potential resource shortages moving forward, how do home builders? How are they looking at the tariff policy uncertainty? Now, we don't know where the tariffs are going to end up, but do home builders feel like they have resilient enough supply chains domestically where if there is this huge price shock from importing certain materials, it really is going to be the binding constraint? Or are tariffs just, going to be, relatively speaking, something the home building industry can survive better than, if you are a clothing manufacturer that gets all of their materials from China?
There's a lot of mixed opinions, and I think that's legitimate because it really does depend on the market you're operating in, the kind of home builder you are. Smaller builders are going to probably be more susceptible to volatility in pricing and availability than a larger home builder that's got scale economies and long-term contracts with suppliers. The type of construction you're doing, are you a spec builder? Are you a custom builder operating on contract basis? Are you more exposed to the remodeling market? But the sense that I get as I travel around, and as the chief economist of a trade association, every week I'm out visiting builders across the country. I just returned from a trip in Denver, and I talk to builders. And I'd say about 40% of the builders I talk to thus far have not seen any kind of impact from tariffs thus far. And keeping in mind, a lot of them have been proposed or put on pause, with the exception of that 10% across the board tariff. On the other hand, the 60% of builders have noted to me they've seen price increases from suppliers. And if you average these things out, including the zeros, the average impact's around $10,000 to $11,000 in cost. And that's suppliers looking through some of the debate and raising prices in anticipation of what could potentially be the fully fleshed out versions of these tariffs. So that's a measurable impact. It's not huge, but it's notable. I think if you ask builders and remodelers and apartment developers what their top hurdle is right now, it's regulatory costs. We've done some surveys of land developers and home builders for the last decade or so. We do these studies every few years, and we find that for a typical newly built single-family home, about a quarter of the final sales price is made up in impact fees, permit fees, and other kinds of regulatory burdens and costs. And so builders will kind of point to that and say, yes, tariffs don't look like they're going to bring anything positive in the short run. But, if I had one thing I would try to change on policy, it would be some of these regulatory headaches. And those materialize at the state and local level, and they can really be huge. And, just speeding up the approval process, reducing some of the fees and taxes. I hear that consistently. But, when we look at tariffs, I think lumber is kind of the example that's often cited. And you can see the issues here because lumber in the United States, about a quarter of the softwood lumber used to build homes, and about 90% of homes are wood framed. But a quarter of it comes from Canada. And we already have a 14.5% anti-dumping duty rate on Canadian lumber. That's a bureaucratic process, not set by the president or Congress. That duty rate is likely to go up above 34% in the coming months. And there is possibility of a Canada-specific goods tariff, 25%. That's effectively on pause right now, but it could come back into play. And just like the president has looked at creating specific tariffs on steel, aluminum, pharmaceuticals, there's an ongoing study on lumber itself. That could be another, say, 25%. So if you stack these things, you can easily get above 75% duty tariff rates. So I think there's some concern. I don't know necessarily how you plan around these things. And that is a consistent lesson and message I'm hearing from builders, which is it's really difficult to price out the product. And keep in mind, to build a home takes 6 to 12 months, and that's typically on land that took 2 to 3 years to develop. It's hard to price when you don't know the cost. So the uncertainty, I know everyone's talking about it, but the uncertainty is a cost by itself as well.
That is really good to put into perspective. I mean, even if the materials and our reliance on imports is a small part of the overall home building, obstacles that are in the way of an ideal housing supply, they can still make significant impacts if we have a shortage of lumber or more expensive lumber. But from your perspective, it really is regulatory changes, and it's not something that necessarily happens at the national level, but state and local. So I think that's really important. Now, another one of the four core areas of federal policy the new administration is focusing on is immigration. The data we have suggests border encounters have totally plummeted so far this year, continuing a trend that started, I think, halfway through last year. Now, immigrants do need somewhere to live. This increases housing demand, but they also contribute to the labor force, so they can help in the actual construction of homes. How do home builders see these forces balancing out if rates of immigration stay very low for the next 4 years? In other words, will there be bigger impacts on housing demand or housing supply?
Yeah, so it's easy to say that it'll be both. In the long run, it's really about demand. One of the factors that has sustained the growth in the rental housing side of the market in the last few years is just the sheer number of immigrants that have come into the country. 3 million a year, more than we forecasted 5 years ago, looking at maybe a million increase in population each year via immigration. So, yes, certainly when we look at the data, border crossings are down 99%. The industry, by the way, is a strong supporter in enforcing those laws. But the supply side matters as well. And one of the areas that we've done research on is the degree to which immigrants make up the construction labor force. And within the residential construction industry, which includes remodeling and an apartment building, it's roughly 3 out of 10 workers were not born in the United States. So the data we have access to is not looking at illegal, legal status, documented, undocumented, but it has always traditionally been the case that construction has been an area where you have a lot of non-native born workers. And that's particularly true in some occupations like framing and drywalling and those kinds of efforts. So that's going to have an impact on labor supply. The industry has had a focus for now about a decade in terms of recruiting and educating people and bringing them into the sector. The irony is when we've done survey research, we often see that builders say that, the real issue is less about immigrant workers coming into the industry, and it's about high school and community college students coming into construction. And so there's a real effort underway, groups like the Homebuilders Institute, trying to bring people up in the middle skills industry and the skilled trades and get them into construction. I know this is something the administration is focusing on, and we're big supporters of that. So, yes, it's going to have both supply side and demand side consequences. I think what the industry really just wants is certainty to kind of know where demand's going to come from in the future, and then what are the challenges in terms of recruiting workers. And by the way, recruiting workers, it's not just kind of a headcount issue. It's also a productivity issue. Because when we turn and kind of, put the microscope on our industry, one of the challenges in residential construction is a real lag in worker productivity. Trying to find new ways to build housing has been an issue in the industry. Not a lot of success thus far. If you look at like off-site construction, modular and panelized construction, it's only maybe 7 to 8% of home building. It should be a lot higher, but those efforts are underway, and I think that will make us a more productive industry, even as we try to recruit additional workers into the sector.
You talked about how regulatory challenges seem to be the biggest obstacle towards increasing home supply more, and that feels like your priority. If you could wave a magic wand, that would be what you would do. But at the opposite end, what keeps you up at night as a potential downside risk for home builders? What are they worried could happen unexpectedly? Is it a recession? Is it, I don't know, a big fire in the Canadian forests that make lumber that much of a shortage? What is kind of a tail risk scenario that you really worry about?
Yeah, this is a great question. Recessions, obviously we worry about them, but home building, a line from a few years ago was home building is the business cycle. It's at the front end, so it's really responsive to monetary policy and interest rates. So when we're forecasting, we are definitely looking through some of the cycles, and you ride the roller coaster, and particularly when it comes to real estate development. What keeps me up at night, those tail risk items, it's shifting away from some of the state and local policy issues. Those are the day-to-day areas where we're seeing an improvement in the conversation. We are starting to see some improvement in policies. Not fast enough. They're too small, but they're coming. But what keeps me up at night, I think, really is more about fiscal policy and a future debt or liquidity crisis. Because if we think about the debt to GDP ratio, the size of the federal deficit, I try to tell builders and those who are stakeholders in the housing industry, the larger the size of the federal debt, the more there is an impact on long-term interest rates. So often the Federal Reserve is kind of viewed as the enemy, or it's the organization that takes away the party when it comes to real estate. But the Fed is the organization that's maintaining long-term or fighting long-term inflation. Where we see the greatest risk on some of those is an ongoing growth in the size of the federal debt, which would push up long-term interest rates, push up mortgage rates. And when demographics are going to turn to a headwind by the mid-2030s, that long-term issue is really what concerns me in terms of the future of home building over the next decade.
A big story early on in the pandemic was this quick increase in domestic migration. People were moving to places like Boise or Denver or the Southeast for better taxes, weather, space, everything like that. How have things settled at this point when it comes to the big picture geographic trends in the U.S.? Where are home builders bullish, and what are the markets that are less encouraging? Because housing is notoriously, a local or regional market. We talk about it in national terms so much, but there's so much nuance depending on the markets you're talking about.
It really is, and it's why so much of my job, I'm based in Washington, but traveling and getting out there and frankly, sort of testing my numbers with audiences of local home builders association members to see whether or not what we're saying is right. Yeah, we're still bullish on the Southeast, the mountain states, and certain pockets of strength in the Midwest, and we can talk about that. Yes, there are some challenges. One of the things we've noticed in the last year or so are markets that were particularly supported by younger home buyers, first-time buyers who are very interest rate sensitive, and places where it was a little easier to build and where you've seen a rise in inventory. Those markets have cooled off. So we've mentioned Denver a couple of times. I just returned from there. That market seems particularly sensitive to changes in interest rates. So to the extent that rates have remained higher, we've seen a fall off in demand. At the start of the year, I visited Austin, Texas. Home prices are down by about 15% from peak in that market, characterized by obviously a lot of inflow from places like California and younger buyers, but interest rate sensitive buyers. So to the extent rates remain higher, you saw some of those buyers move to the sideline. And of course, there's a lot of discussion right now about Florida and rising inventory. Some of that is due to issues like insurance pricing. A lot of it is, though, connected to the condo multifamily market. That's where the largest amount of rise in pricing is. And Florida typically has a lot of volatility, but in the long run, we still see a lot of population and job growth. And I mentioned the Midwest. Often, if you look at the regional data, say, the Midwest looks a little flat. It's not growing as fast as these mountain state and southeast areas. But if you think about kind of the future over the next decade, you kind of want to identify markets that have good housing affordability right now, that are near large universities with an educated workforce, and are a little bit colder than the rest of the country, because if you think about AI or data center type use, it's all about managing energy and heat. And so some of those northern markets could get a second and third look as we move forward. So I hear a lot of builders excited about places like Columbus, Ohio, Indianapolis, and Kansas City.
Well, I really hope for my own good. I live in Chicago, and if housing values could really go up after I get my first house, that would be really good for me. What is your outlook for residential construction and house prices over the next few years? And of course, that is the big crystal ball I'm sure everyone is asking you, because we might go through another business cycle. We don't know where interest rates are going to go. But are house prices going to cool off from those peaks we saw earlier in the pandemic? I know you mentioned Austin. My understanding is that prices in Austin have gone down, not necessarily because those population inflows reversed, but because they actually built a lot of housing. So what is your outlook for the next few years for construction and house prices?
Yeah, anytime we're talking about forecasts, we do have to kind of note that things are more uncertain now just because of some of the policy debate issues. But generally speaking, if we're talking about kind of the medium and long run, we're a little bit more bearish in terms of some of the home price forecasts than other groups. I've got home prices roughly flat this year on indices like the National Case-Shiller Index. And the reason why is we see some markets being down and some markets being up, kind of washing out. So I think an increasing number of local markets are going to realize some declines off of peak pricing. Some of this is due to that rising existing home inventory. And those existing homeowners who have been kept out of the market because of the mortgage rate lock-in effect, they want to have to give up those low rates. But now life happens and they have to move. They're going to have to undergo a process of price discovery that builders underwent 2 years ago. And so they may realize that the prices that they, online or through other sources, they thought their homes were worth, it's worth a little bit less when the new normal for mortgage rates are 6.5% to 7%. When it comes to home building activity, we built about 1 million single family homes last year. We think 2025 is going to be roughly the same. And over the medium run, so over the next 5 years, there's a pretty good runway for home building activity because of where we started, that structural housing deficit that we think exists. We think that will take us ultimately up to about 1.2 million single family starts a year. And then in the mid-2030s, that begins to fall off because of some of the demographics. Gen Z and Gen Alpha are smaller than the millennials, and that will result in some declines in home building activity. And then one thing in our outlook that I think does make us a little bit different than other groups, we're really bullish on remodeling. We have an aging housing stock. Homeowners have more than $30 trillion in home equity. We just see this as a growth area. It's going to gain market share in residential construction activity, and it's an industry ripe for investment and disruption. It's highly decentralized, lots of small companies across the overall country, and we just see growth in this market. There's kind of a satellite industry in terms of home building, which is tear down construction. If you live in a larger metropolitan area, you probably see a lot of tear down construction in inner suburbs. That's about 10% of home building, and that share is likely to go up as well. So there's some real growth trends that are going to be in place. There are some headwinds that are coming in terms of the demographics, but for the back half of this decade, if we can navigate some of these policy uncertainties, we see a pretty good runway for home building growth through at least the early 2030s.
That makes total sense, and I have to say I've never thought about it. If the housing market really is in this mortgage lock and people are staying in their homes longer, well, then it makes sense that they want to remodel and kind of refurbish, and that provides its own demand within the home building industry. So, Robert Dietz, thanks for coming on the podcast.
Yeah, great to join you today.
That was Robert Dietz, chief economist with the National Association of Homebuilders. With so much focus on tariffs within the business community, it's interesting to hear Robert say that what homebuilders see as the primary obstacles to increasing housing supply are building regulations and a sustained lack of construction productivity. Federal policy changes on imports and immigration will have meaningful impacts on the housing industry, but the longer-term issues go beyond today's macroeconomic environment. The Fed is widely expected to leave the Fed funds rate unchanged next Wednesday. Investors will focus on the new Summary of Economic Projections and press conference to see whether Fed officials have changed their perspective after a few months of soft labor market data and slowing inflation. The last two dot plots have shown a median estimate of 2 rate cuts in 2025, largely in line with what the market is pricing in now. Shortly after the Fed's policy announcement, Treasury will release data on international Treasury flows for April. The decoupling of the dollar and longer-term Treasury yields since the April 2nd tariff press conference has led many to believe that new trade policies have caused a global shift away from U.S. assets. Although Treasury auctions and other peripheral data have not shown any concrete evidence of falling demand for U.S. Treasuries, this report will give the clearest sign of how different countries' investors responded to the shock and awe of the earliest tariff announcements. We'll also see retail spending data for May next week. Household spending trends have been distorted by efforts to front-run tariffs, but this report will be an important indicator to gauge whether consumers stayed resilient through deteriorating sentiment and higher effective tariff rates. The following week, we'll see the May PCE on Friday the 27th. Given the ultra-cool May CPI released this week, the report's inflation metric is expected to be benign, so the focus should be on the personal spending data. Falling consumer sentiment has so far not translated into any meaningful slowdown in household spending. This year's big fiscal package will also continue to work its way through the Senate and House. Republicans hold a small majority in both chambers, so placating the moderates and fiscal hawks will be no easy feat. The White House had originally aimed to pass the spending bill by July 4th, but it looks more likely than not that it will take until late July or early August before the legislation is finalized. That's all for today's episode. Thanks again for listening. I'm Will Compernell, macro strategist with FHN Financial. This episode was edited by Bill Stanfield. Don't forget to like and subscribe to Simply Put wherever you get your podcasts. Email simplyput@fhnfinancial.com with any questions or comments. This podcast is presented for informational purposes only and is not intended as an offer or solicitation with respect to the purchase or sale of any security. Views expressed herein accurately reflect the speaker's personal views about the data, news, trends, events, etc. discussed herein or any subject securities or issuers. No part of their compensation was, is, or will be, directly or indirectly, related to any specific recommendations or views expressed. FHN Financial, through First Horizon Bank or its affiliates, offers investment products and services. Investment products are not FDIC insured, have no bank guarantee, and may lose value.